If I told you that the next 7 to 10 days could decide whether markets rip higher or snap into a full-blown risk-off panic, would you be ready? Right now, traders around the world are glued to their screens, watching a wall of US data roll in: jobs, inflation, growth, and all of it is landing right as the Federal Reserve weighs its next move. One surprise print, one unexpected line in a Fed speech, and the entire risk landscape can change in seconds. In this video, we're breaking down why traders are bracing for a Federal Reserve shock, what this incoming data wave really means, and how you can position yourself so you're not the one holding the bag when volatility hits. So grab a coffee, sit tight, and let's get into it. Hey everyone, welcome back to the channel. Today's video, traders brace for Federal Reserve shock as critical US data hits markets. By the end of this video, you'll understand why this combination of Fed policy plus US data is such a dangerous cocktail for markets, which specific data points traders are watching like hawks, the three main market scenarios that could play out, and a simple, practical playbook to manage risk and look for opportunity in the chaos. Let's start with the big picture. We need to answer one question first. Why is everyone so nervous about the Fed right now? The Federal Reserve isn't just some distant institution. It's the central bank of the world's largest economy, and its decisions ripple through stock markets, bond yields, the US dollar, real estate, and yes, even crypto. When the Fed raises or cuts rates, it changes the price of money. Higher rates mean tighter financial conditions. Borrowing costs go up, valuations get squeezed, and speculative assets feel the pain. Lower rates. Liquidity increases, risk assets usually love it. Right now, the tension comes from uncertainty. Markets are asking, is the Fed finally done hiking? Will they pivot sooner than expected? Or will sticky inflation force them to stay hawkish for longer? And the answers to those questions depend heavily on the data that's about to hit. Let's talk about this data wave. What are we actually getting? Traders are watching a cluster of high-impact reports, typically including things like inflation data, CPI or PCE jobs data, non-farm payrolls and unemployment rate growth data, GDP estimates or revisions activity data, PMIs, retail sales, consumer confidence, manufacturing reports. Each one is a piece of the puzzle the Fed uses to judge: is inflation under control? Is the economy slowing too fast? Are financial conditions tight enough? For example, if inflation comes in hotter than expected, traders immediately think, oh, the Fed might have to stay aggressive, maybe even hike again. If jobs data is extremely strong, it suggests the economy isn't cooling as much as the Fed wants, which again keeps the door open for tighter policy. If growth and consumer data start rolling over hard, markets worry about recession, and suddenly people start betting on cuts, but not in a good way, more like emergency cuts, to save a weakening economy. This wave of data isn't just numbers on a screen. It's the scorecard for how well the Fed's previous moves are working. On their own, each report is important. But what makes this particular period so explosive is that the data cluster is landing right as the Fed is at an inflection point. Think about it, after months or years of aggressive rate hikes, the Fed is now trying to decide, have we done enough? Are we risking breaking something in the system? Can we start thinking about cuts, or is inflation still too dangerous? Markets hate being in the dark. When the Fed is either clearly hiking or clearly cutting, traders at least understand the direction. But in moments like this, where one data print can flip the narrative from soft landing to hard landing or second inflation wave, volatility goes through the roof. That's why, heading into these reports, you'll hear phrases like, traders are bracing for impact, positioning is cautious, risk is being taken off the table. Translation: big money doesn't want to be overly committed just before the Fed gets new information that could change the game. Let's zoom in on how various markets typically react when critical US data hits and the Fed is in focus. 1. Stock market, equities, growth stocks and tech names are very sensitive to interest rates. If the data suggests lower future rates or a sooner than expected pivot, these can rally hard. If the data implies higher for longer rates, you often see sharp sell-offs, especially in high valuation names. 2. Bond market. This is where the smart money often reacts first. Hot inflation or strong jobs data. Yields typically spike as traders price in more hawkish Fed policy. Weak data. Yields can drop as traders bet on cuts or slower hikes. 3. US dollar. A more aggressive Fed tends to strengthen the dollar, as global investors chase higher yields in US assets. A dovish turn or weaker data can soften the dollar, which in turn can boost commodities and risk assets around the world. 4. Crypto and AMP. Other risk assets. Crypto often trades like a high beta macro asset, especially Bitcoin and larger altcoins. Liquidity and risk sentiment, both heavily influenced by the Fed, can cause big moves. Hawkish Fed tone. You'll often see crypto struggle. Hints of easing or policy flexibility. Crypto can rip higher as traders lean into the liquidity is coming back narrative. Understanding these dynamics is crucial if you're trading around key events rather than just watching the chaos from the sidelines. Now let's build a simple scenario map for this upcoming data wave and Fed reaction. Obviously, no one can predict exactly what will happen, but traders like to think in probabilities and plans, not predictions. Scenario 1. Hawkish shock. Inflation runs hotter than expected. Jobs data stays strong, unemployment is low. The Fed leans hawkish in its statements, emphasizing higher for longer, or even reopening the door to more hikes. Market reaction could look like equities sell off, especially growth and speculative names. Bond yields push higher, especially on the short end. The US dollar strengthens. Crypto and other risk assets come under pressure. This is the brace for impact scenario. Traders in this camp will often reduce leverage, tighten stop losses, hedge with options or defensive sectors. Scenario 2. Dovish relief. Inflation comes in cooler than expected or shows a clear downward trend. Jobs growth slows gradually. No disaster, but enough to suggest cooling. The Fed signals it's comfortable pausing, and maybe lightly hints at future cuts if data keeps improving. Potential reaction. Risk assets rally. Stocks, crypto, high-yield credit. Bond yields drift lower. The dollar softens, benefiting commodities and non-US markets. This is the relief rally traders dream about. But here's the catch. If everyone is positioned for this outcome, the move can be short-lived. Smart traders are careful not to chase too late. Scenario 3. Mixed and AMP. Messy. Some data is hot, some is soft. The Fed's messaging is cautious and nuanced, not clearly hawkish or dovish. This is the most realistic scenario, and sometimes the most confusing. Markets may chop around, violently spike one way on a headline, then reverse as people read the details. See big intraday ranges with no clear trend. In this environment, overtrading can kill you. The winners are often those who wait for clarity or trade only the cleanest setups. So what do you actually do with all this? Here's a simple playbook you can adapt to your own style, whether you're a day trader, swing trader, or longer-term investor. 1. Know the calendar. Don't get blindsided. Make sure you know the release times for major reports, any scheduled Fed speeches, press conferences, or minutes. Many traders avoid opening new positions right before a major event, or they size smaller to account for the spike in volatility. 2. Size like volatility matters, because it does. During big data weeks, the market's average daily range can expand dramatically. That means your usual position size might carry more risk than you think. Normal stop loss might get hit by noise alone. Consider reducing size or widening stops, but only if you truly understand the risk you're taking. 3. Have a plan A and a plan B. Before each key event, ask yourself, if the data is stronger than expected, what do I do? If it's weaker, what's my plan? If it's mixed and choppy, do I trade at all, or do I step aside? Writing this down can stop you from making emotional decisions when the numbers hit. 4. Watch the bond market and dollar first. Often, bonds and FX react faster and cleaner than stocks or crypto. If you see yields spiking and the dollar ripping higher, that's usually a sign of a hawkish interpretation. Yields falling and the dollar weakening, that leans more dovish. Equities and crypto often follow the tone set by those markets. Don't confuse short-term noise with long-term trend for longer-term investors. This kind of week is noisy but informative. Data and Fed comments can shift the long-term path of rates, change the probabilities of recession or soft landing, affect how you think about sectors like tech, financials, real estate, and energy. But one bad day or one spike doesn't automatically destroy a long-term thesis. The key is to distinguish between temporary volatility and structural change in the macro backdrop.